month's market update. I'm joined today by KC Lowe, Senior Consultant with Frontier Advisors. Hi there, KC.
Wayne.
So late last year, we saw some signals from China about the reopening of their economy. A couple of months in from that, how have things been unfolding?
Yeah, so that's right. So early December, Chinese authorities announced that they will be pretty much removing the zero COVID policy, which our expectation was that China was going to reopen at some point. But in terms of the how quickly they've done it and how abrupt the process has been, that's been a bit more unexpected to us. So over the last few weeks, since early December, they've been removing testing requirements, removing restrictions, border controls, and it's been a really quick process. So one of the things that we think is important is just tracking how quickly they recover from this reopening process. So we've been relying on some high frequency data for that. So one of them, for example, is subway passenger traffic in major cities in China. And when we look at that, the data is still a bit volatile because we had the New Year period, the Lunar New Year period, but it seems like at least from a mobility perspective, activity in China is recovering quite rapidly. So that's a good sign for economic growth there. So recovery in China's demand is going to be positive for global growth, particularly during a period where what seems to be that Western economies are slowing down. So that's offsetting that a bit. So that probably will have a positive flow through. It will be a positive factor for the Australian dollar, for example, because you expect commodities demand from China to pick up again, which we've seen a bit in terms of iron ore prices picking up. So that's probably going to be supportive for the Australian dollar. But the other side of it is that with the increase in demand from China, that's probably going to put more pressure on inflation globally as well. And that will probably make the job for central banks more difficult too.
Well, speaking of central banks and their fight against inflation, our own central bank, the Reserve Bank of Australia, met recently. Another interest rate hike, KC. What does that mean for us?
Yes. So the Reserve Bank of Australia had the first meeting of the year, and as you said, it increased interest rates again. So it's increased by another 0.25%. It's 3.35% now for the cash rate, which is still, when you think back, this time last year it was still 0.1%. So it's been quite a steep increase in the cash rate over a short time frame. The key thing for us when we think about this is in the statement that the RBA has mentioned that their focus is still on inflation, and that they expect that interest rates will continue to increase in the coming months ahead. So the emphasis here is on the plural, increases. So they're expecting to increase the interest rate a few more times to come, and that has impacted market expectations. And you look at that current market expectations after the meeting is that the cash rate will likely increase to close to 4% later this year, but the market is also expecting it to start to decrease next year and start to come off to about 3.5% by mid-2024. So unfortunately, it looks like it'll be more pain for households with mortgages.
So we'll have to keep recording these videos for a bit longer, KC, to pay our mortgages off, obviously, which will be good. Thanks for joining us for this month's market update.